Hi everyone, Larry Berman here, and here's what's on my radar this week. Well, Employment Friday, both here in Canada and in the US, and there were several surprises. Misses on both sides in the respect of the new jobs expected, or more losses than expected here in Canada. But when we look at some of the other metrics, we start to think about inflation pressure. So inflation's on everybody's mind this day. Is it transitory? Is it not? When we look at the 10-year nominal treasury at 156, and then we look at the break-even analysis, and we look at the five-year forward expectations, we basically see a transitory pricing that nobody believes that there's any meaningful teeth to inflation here. And I have to say, I'm in that camp. I think there's lots of reasons why we won't see permanence here. With the exception of the inequality issue and governments of the world being forced by the electorates to rectify that situation. The situation doesn't get rectified by trickle down. It's been proven that the K economy, the guys that have the assets and the people that don't have the assets have very different outcomes. So I think there's going to be a lot of policy effort in the years to come in boosting wages, in making unions stronger. Again, I'm not advocating for this. I'm not saying it's wrong. I'm not saying it's right. I'm just saying this is my observation of the world and how I think it's going to play out and what it ultimately means for people's purchasing power. And I think there's a mandate from the electorate to take us back to that. I'm not talking about socialism. I'm talking about fair pay for fair work. I'm talking about fixing inequality issues where when the Fed cuts interest rates, it helps people with money, doesn't help people who don't have exposure to risk assets and capital. There's two types of income. There's income from your savings and your capital, and there's income from your labor. Those are the only two sources of income. Well, there's the government income, and that's tax, and let's not go there for the moment. So the inequality issue, I believe, is going to impact corporate profit margins. Companies, being the beast that they are, will trim labor force, will invest in productivity, and that is another issue altogether. But there's so many deflationary forces in the world right now, including the massive amount of debt. You're not going to see runaway inflation. So the inflation, I believe, is going to be much slower to build. And it's wages going up, it's unions getting stronger, measured in years and years and decades to come. So I believe it's coming, but I think it's going to be slower. What we're seeing now seems to me it's all supply driven. And so for a trade of the week perspective, how do you play inflation? So bonds responded positively to the weaker data, i.e. inflation is going to be pushed down the road, let's not worry about it. I think a good trade now, because we're seeing this squeeze in treasuries, is now to go short treasuries so an inverse TBT or TBF ETF to go short treasuries is probably a good long trade. So that's a short and a long, however you want to look at it if you're using the inverse ETFs. And how do we benefit on the long side from inflationary forces? And I've talked about for months now base metals as the great way to play that, all kinds of commodity plays. There's still a lot more room left there. There's going to be noise, there's going to be volatility, but being long commodities and short bonds seems like a good trade for the trader types out there. Much harder to implement for mom and pop kind of portfolios where you're thinking about bonds and stocks and balance, and shorting bonds isn't really something for you. Anyways, start to enjoy the better weather. I'll look for me on the golf course on the weekend. Have a great one, everyone.